Okay, guys, welcome back. So, we're going to continue with our pro forma financial plan or financial statements here. So, from here, what you want to do is you want to think about all of your startup costs. One of the biggest mistakes that entrepreneurs make is underestimating their initial startup costs, and that's because they forget about little things. So, what you need to do is sit down and make a list of everything you can possibly think of. You want to think about if you have to do a build out, the engineering, the design, the architecture, all of those are permits that require deposits and payments. Capital improvement costs. You want to think about what kind of equipment you need, what kind of furniture do you need, what kind of fixtures. How do you want to decorate the inside? What theme are you trying to bring about? You need to think about how you're going to hire people. Are you going to hire an outside entity to try and bring you recruits? Or how are you going to get them to your door? Are you paying newspapers? Are you all of those sorts of things you have to kind of think about. Like I said, most people underestimate their costs, and it's because they forget things. So the number one item that's forgotten for retail, like clothing stores, is hangers. Hangers alone cost on the low end about $3,000. Something that one of my restaurant friends said that is forgotten a lot is plates and silverware. They forget to put it into their startup expenses. And so my first thing for you is to turn off the video, and I want you to brainstorm every single thing that you can think about for startup costs. Your insurances, getting together your business licensing, all of the things that you need to get started. So it should look something like down in our right hand corner. You're going to make a list and you're going to find out how much each one of those things costs. So if you're going to get 5,000 pieces of inventory, that costs you $50,000. Your insurance for a year broken down into payments every 3 months ends up being $1,500. You've got deposits on your building for rent, and your utilities are going to have deposits too. I think when I did like SDG&E, it was like a $600 deposit. So you've got all of those types of deposits. And then you've got to pay for your building and business permits and all of those things. So it should look something like this. Hopefully yours will be a lot more comprehensive than my little example right here, but highly recommend doing this first. Okay, then what you're going to do is you are going to jump into your labor costs. Labor in most industries is your biggest expense, okay? So look back at all of the research that you've been doing for your business idea. And you want to think about what you found out about times that it's busy, average, slow, what days, times, and seasons are busy and slow, and then create a mock schedule for different scenarios and add up your total labor costs. So if you're figuring, okay, we're open, 7 days a week, we're open 8 to 5, and we're going to need coverage 2 different shifts, so we're going to need 3 people a day so that we can cover breaks and da-da-da-da-da. And so now you've figured out how many hours you need. So I need to cover a total of 126 hours this week, which means that I need this many people and it's going to cost me this much money, okay? One of the things that I always suggest too is add somewhere around 8% to account for taxes and vacation pay when you're figuring out your labor costs. For some people, they'll add more, up to like 11.3%. I think 8 worked for me. It works for a lot of people, but you can always adjust that based off what works for you. But to account for taxes and vacation pay, if you're someone who's offering health insurance, you'll want to increase that. And so just kind of mess around with that and see what works for you, but add at least 8%. Okay. When we're talking about our different expenses, there are 2 types of expenses. So a fixed expense is an expense that does not change no matter what sales are. So this would be your rent. This would be your insurance, your liability insurances. Generally, your internet and your phone are going to stay the same month to month. If you have salaried employees, most of the time you've agreed on a specific payment for each month. So these are things that are fixed. They're not going to change. And so you can count on them to be the same each and every month. Variable expenses, however, are going to remain flexible or change often. So a variable expense is labor, just like we were just talking about. There's busy and slow times. Sometimes you need a lot of people, sometimes you need very few people, and so your cost is going to reflect that when it comes to labor. Materials are always changing. Your utilities, here in San Diego, nobody really has AC, but during the winter we start pumping our heat, and that's going to fluctuate our utilities, right? Or utilities are going to fluctuate with those busy and slow times that we were talking about. Credit processing fees are something that are going to change with your sales. So you get charged a percentage of your sales for credit processing fees. Your shipping, you never know how many things you're going to ship or how far when you're running your own business. And so this is something that's going to be varied month to month. Another thing that you need to be familiar with, or other definitions you need to be familiar with, are assets and liabilities. So an asset, by definition, is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit, okay? So when we're talking about assets, we're talking about things like inventory, accounts receivable. So what that means is that you're expecting somebody to send you money. You've sent a bill out to them and they're supposed to make a payment. So that's accounts receivable. That's money coming in. You're receiving it. Cash that you have in your bank accounts, or cash on hand that you have, right there at the store. Any equipment that you've purchased, machinery, intellectual property. So things like trademarks and patents, copyrights. These are all assets, okay? Now there's two different types of assets. There are fixed assets. So that's property that will be useful for more than a year. So useful or usable, or you may have it for a long time. So fixed asset is something that is going to be around for a while. A current asset is something that can be used really quickly. For example, cash or accounts receivable. Those are going to constantly fluctuate, and you're going to be able to use them really fast. Liability in general, a liability is an obligation between one party and another that is not yet completed or paid for. Okay, so you've agreed to give somebody money for something is essentially what a liability is, or you've agreed to do a service for somebody. So when we're talking about liabilities, we're talking about debts, any type of debts that you have, loans that you have, accounts payable. So you're supposed to be paying someone, so maybe your vendors. Wages payable, you're supposed to be paying your employees. And so again, we've got two different types of liabilities. We've got our long-term liabilities. So these are those, 5-year loans that we took out for the build out of our store. So that's over 12 months. And then current liabilities, which would be things like wages payable, accounts payable, because we're going to do that every month, right? We're going to be paying that down every single month. So these are just definitions for you to understand as we move through into our big sections, which are going to be our next spreadsheets that we're going to get into. Okay, so the first one that we're going to create after our sales forecast, we're going to do our sales forecasting first, and then everything is kind of loosely based on our sales forecast that we created in the last video. So opening day balance sheet is going to show your specific financial position at any given time. So anytime you see the word balance sheet, it's essentially a snapshot of that specific moment in time. How are we doing right now, right? You will want to know what it looks like for opening day. So what you'll do is you'll go back to that startup sheet I was telling you about listing all of your expenses and costs in order to get your business open. And you want to look at it and decide what on that list counts as assets and what counts as liabilities. And then you want to group up your current and fixed assets into small categories. You kind of want to condense them. And then you want to group your liabilities, by long-term and current. And what you'll end up with at the end is your owner's equity, okay? So owner's equity is what is left when you have subtracted liabilities from assets, okay? So let's take a look at what an opening day balance sheet looks like. So you've got your current assets, which are your cash in the bank, your inventory, prepaid expenses. So an asset would be if I've paid for an entire year of insurance. I've already paid that ahead, and I didn't have to, right? So prepaid expenses, prepaid legal services, things of that nature. Fixed assets are going to be, remember, those long-term machinery and equipment. I'm going to have those for more than a year. Furniture and fixtures, I'm probably only going to update those every, 5 to 10 years. Leasehold improvements. So this is anything that you've built inside of that building to make it better. So your build out, your design, those sorts of things. Whether you own the real estate, so that could be a fixed asset because you're going to have that building for a long time. And then what you'll do is you'll start to move down to your current liabilities, which would be, again, your accounts payable, your taxes payable, notes payable, anything that's due within 12 months. So that's just money that you owe. Current portion of long-term debt that you have to pay down. And then you've got your longer term liabilities. And then it comes down to our owner's equity, or our net worth is what owner's equity essentially is. And so, like I said, it'll be all of your assets less your liabilities is what your net worth will end up being. Now, I'm going to attach all of these examples. These are actually templates from the SCORE website. But remember, you do have SBDC Live Plan that you can log into, and you can put in all of your numbers for each one of these financial statements, and it will automatically calculate for you. I just want you to understand what it is, or the reason why you're doing it, or you have a kind of understanding of how this all works. So that's why I'm still teaching you this anyway, even though you're just able to type in your numbers. You need to know why you're putting each number in each spot, right? All right, so next on our list of financial statements is going to be our profit and loss, also known as a P&L. So this pro forma statement shows you your sales and overhead expenses. Another word for overhead expenses is going to be your operating expenses, and so you'll see me use those interchangeably. So that's your day-to-day, keeping your business running expenses, okay? So for profit and loss, you will include your sales forecast numbers minus your cost of goods to figure out your gross profits. Okay, now remember, we learned how to do cost of goods in our last video. If you need an update, I suggest pausing and going back to that. Once you have subtracted your sales forecast numbers from your cost of goods and have your gross profits, you're going to take your gross profits and you're going to subtract all of your operating expenses. And this is going to get you your net profit before taxes. This is also known as an EBIT, which is an earning before interest and taxes. Lastly, you will subtract all of your taxes to come to your net operating income. So everybody wants to get to this number because the net operating income is what you get to actually keep or reinvest into the business. So those are your actual profits, okay? So while we're talking about profits, gross profit margin is your revenue less the cost of goods sold and labor, okay? So for example, if you sold $30,000 this month, and your cost of goods sold was 33%, that would come out to $9,900. Your labor cost for 7 employees working 30 hours a week at $12 an hour would equal $10,080 plus 8%, which is $10,886. Your formula for operational profit would look like this. So it'd be $30,000, subtracting our labor and our cost of goods added together. And so our gross profit would come out to $9,214. Okay, so like I said, net income is net operating income, or net income is the number most business owners want to get to, because like I said, it's the one that you get to keep, and you get to put it back into the business, or spend it how you want. It is all of your sales revenue less expenses, costs, and taxes. Okay, so this is what a profit and loss projection should look like for a 12-month period. Now, you may not have, if you look at the top left, it says category 1, category 2, category 3. You may not have that many categories in your sales mix. And so you may have just 1 or 2 products. You can absolutely just list those. And also, please delete category 1, category 2, and actually give them a name of what your product is. But, for instance, if I was a makeup artist, it would be like special events would be one category. And then the next category would be tutorials. And then, the next would be like selling of some of my product, right? So actual products. And then I may even break those down into categories. And so you have all of those broken down. Then you get into your cost of sales section. So how much did it actually cost you to manufacture, produce, sell your service, create your service? How much did it actually cost you? And so you have to include the cost of sales. As you continue down with profit and loss, you've got all of your sales revenue up top, the cost of those sales, and then you have your overall expenses. So we've got salary expenses, payroll expenses, taxes, utilities, rent. All of that is included, and you want to subtract those from each month as you go through your P&L. And then one that I wanted to point out is kind of towards the bottom. You'll see reserve for contingencies. You always want to make sure to try and have some backup money just in case. And so I always suggest having a contingencies fund just in case something happens. There's a lot that pops up when you're a business owner that you weren't expecting, and it's nice to have some backup. I also have one of my very good friends. She makes sure that whenever she's creating her budgets, that she over plans by 15% in order to have a contingency fund. So just something to think about in the future. And then you'll need to find out wherever you're doing business, what tax percentage is for federal income tax, state income tax, local income taxes. And so you'll plug all of those in. So this is what a P&L looks like, what it includes. And like I said, you're just going in and you're plugging in each individual number. Okay, so next we have our cash flow projections. And so we've already done a lot. So we have forecasted our sales. We have figured out what our expenses are going to be in total, and how much money we have to come up with in order to get our company started. We've even done a profit and loss to see, how we're going to fare over time. But we need to figure out our cash flow. So figuring out your cash flow is going to help you manage your funds in the future. And the reason why is because not every expense is going to be monthly. Not every customer is going to pay you every single month. And so you may have some months where you're a little light and some months where you've got a whole bunch of checks coming in. And so you have to really consider what that ebb and flow might look like, because every business is going to have it. And so you want to come up with a realistic vision of what that cash flow might look like. Some examples of this, like I said, if you were in the construction industry, It could be, a month before you receive a check from a general contractor because they have to wait for the client to approve everything. They have to wait for inspectors to approve everything. They have to get cut a check, then they have to pay you a check. And so it takes time, in some cases, for you to get that money that's owed to you. Or in the case I already mentioned with things like insurance policies, sometimes you only pay them once every 3 months. And so that money isn't coming out every single month. And so this is where cash flow is important so that you can plan and manage your funds better. The other thing about cash flows is that they do include some things that a profit and loss will not. For example, things like owner withdrawals. How much are you taking out? So profit and loss will only show wages that are paid, but an owner withdrawal is not a wage. It's just money you're personally taking out of the company. So let's take a second to look and see what a cash flow should look like. So this is what a standard cash flow would kind of look like. You've got your cash sales going on up here, and then cash paid out. So these are all of your expenses that you have. This at the bottom is not important. So this is what a general would kind of look like, and you would just plug in all of these numbers. And like I said, you've got down here owners withdraw, capital purchases where you used cash to buy something, and so this is what your cash flow should look like. And so you should do a 12-month cash flow as well. All right. Now, the last thing on our list here is a break-even analysis. So this analysis is so great because it allows for you to figure out exactly how much money you need to just break even, meaning that you neither made a profit or a loss. So it's just enough to slide by, basically. It's really important for you to know what your break-even point is. You'll also hear break-even point referred to as a BEP, so also keep your ears peeled for that. So the way that you'll come up with your break-even analysis is you'll go back to your P&L and categorize your expenses by fixed and variable expenses. So remember we talked about that in the beginning. So a fixed expense isn't going to change. A variable expense is going to change all the time. And so you'll want to go and you'll categorize those expenses, like I said, by fixed and variable, and you'll come up with a total for those annual expenses. Then you'll look at a few categories within variable expenses. So you want to look at cost of goods sold, inventory, materials, and direct labor, including taxes, what you paid in tax. And you want to take those annual numbers and divide them by annual sales in order to calculate variable cost percentage. Okay, so basically, let's say that I had direct labor of $33,600 and sales were $200,000. I would take $33,600 and divide it by $200,000 to figure out that I've got 16.8% variable cost percentage in my direct labor. Okay. Now, the reason why this is important is because you would do this for every single one of those categories that I was talking about. So for cost of goods sold, inventory, materials, and you would end up with a total percentage. Maybe it's like 45% when all is said and done. And you would use this total variable expense to figure out your break-even formula. So you take total fixed expenses and divide it by 100%, subtracting total variable expenses that we were just talking about, divided by 100%. I know that this sounds really weird, but you'll see what I mean in the next section here. So at the top, you're going to have your variable costs. So again, that's your COGS, your inventory, raw materials, direct labor costs, and then all of your fixed costs. And you're going to add all of them up to create your total fixed cost and your total variable cost, oops, which will then be our break-even sales levels. So let's see if I can pull this up here. So let's say that our cost of goods was 22%. Inventory was probably like 30. So see how these numbers are changing here. In a program like this, it automatically puts all of these numbers in for you. And so we'll put, you just start putting numbers in. I'm literally just pressing the keyboard. And so you can see it starts total fixed expenses. So our total variable costs are here. So that was the numbers we placed in here between the cost of goods sold and inventory percentage. And remember, this is whatever the annual cost for this was divided by your annual sales. And that gives you this percentage. And then you're going to add up all of the costs associated with these. And that's going to be here. And then it'll be total fixed expenses divided by 100%, or the number 1, minus this percentage multiplied by 100%. So, and that gives us this number here. So this allows for you to know how much money you need to break even.
You will also hear people refer to break even as a point in time that they're going to break even. And so you can look at your sales forecast and see how long it's going to take you to make that amount of money to break even. So I hope this helps out. That's all I have for now. See you in the next video.